In this video, I wanted to cover a small cap healthcare insurance company by the name of OSCR Health. And this stock I discovered really through just collaborating with another content creator who was interested in OSCR, asked me for an opinion. I hadn't looked at this stock, so I took a quick look at it and thought it was a really nice stock. So I carried it into a live stream I did yesterday. I did a deep dive into it. And just everything I saw was impressive. Just really good growth company with very good profitability and incredible free cash flow. So I did a valuation and I've decided to start buying this stock. And I wanted to share with you what I'm seeing that's compelling me to become an investor. First, do I like this industry? I certainly do. It's not an industry that's been all that popular for investors, but historically, companies like United Healthcare really show that this industry is worth a lot. United Healthcare is a big cap. It's been a big cap for a long time. Last year or two, it's been rough for this particular industry, but that in itself provides an opportunity for investors to come in and pick up shares at a discount. And I like discounts. I like buying low and watching that investment go up. Now, health insurance is desirable because just think about the business model. People, companies buy health insurance and we pay our premiums and we send them into the insurance company. They get our money. They do their best to basically expect to pay out less than the premiums they collected. In this case here, it's about a 80% ratio. They're paying out 80% of the money they're collecting, but they're collecting all the money at once. So they get to hold that money, invest it, earn interest on it. And we know that interest rates are going to stay a little higher for longer. So they get to make money on the interest of holding that cash and doing something with it. So in general, this is a really good industry. The other thing too is customers tend to be sticky, meaning people don't switch their health plan all that often. It's kind of a pain in the neck, right? If you were to switch your health insurance company and your doctor, every time you go to the doctor, they ask, have you had to change your health insurance? Because there's a lot of paperwork involved. And I think, my experience with healthcare is I like to keep it stable. That way my family is well taken care of. And I think a lot of people feel that way. There's very little changeover. So Oscar tends to keep their customers, as well as the other health insurance companies, tend to keep their customers a long time. So the customer acquisition costs are very rational. So Oscar Health, I like the industry. I like the fact that the market's been really discounting healthcare stocks. And that's part of my reason to buy Oscar. Oscar is a small cap stock with $3.37 billion market cap. Revenue is about 3 times higher. It's interesting that revenue is higher than the market cap. They are profitable. Their forward PE is 17. Very, very good forward PE. Analysts say it's a hold, but if you bought it, you're getting a 60% discount. And 8 analysts are covering the stock. So it's not just one person saying that. That's pretty good to me. It looks pretty good. Over the past year, the market has not been in love with this stock. And frankly, the market hasn't been in love with healthcare paying stocks. We had the horrible situation with United Healthcare, the CEO being assassinated in New York. There was some angst against the health insurance company. And I know that, the new administration has a leader of the health department, Kennedy. He's supposed to be a really anti-health insurance company guy. But I would say that I think that story is a little overplayed. I don't think that the new administration is going to change health insurance benefits a whole lot, because people will get very angry very fast if you start messing with that. People buy health insurance companies so they can feel like they're taking care of themselves, their families, their loved ones. And when government starts messing with that, it gets pretty bad for whoever's in leadership very quickly. So I think that the story, I think Kennedy's probably going to go after pharmaceutical companies that are doing like the weight loss drugs and maybe some drugs that are, helping people that didn't take care of themselves and that maybe people don't have a healthy lifestyle, so they depend on drugs and stuff. I think that's his angle. And I don't know the guy all that closely, but I think the story in general is overplayed, and health insurance companies are receiving a lot of, negative tension, most definitely over the last 6 months. Now, I invest to buy low and see an investment go high. So I'm okay buying and then holding for a year, 2 years, and then making a windfall. And I think if I buy the right companies, that's going to be the case. This is setting up really nicely. Now, the stock has sold off in the last, call it 5 months or so. And I think some of these stories, right? United Healthcare, the CEO, the new administration, it's really having an impact on the stock price. Now, the company is not the stock price, and the stock price is not the company. The company itself has been really operating impressively. Here's the evidence for that statement. In 2021, they grew revenue by 384%. 2022, they grew by 110%. 2023, they grew by 47%. This last full year, they grew by 56%. Tip my hat to Oscar Health. That is tremendous. Very well done. So they did it in this past year profitably. Impressive. High growth, impressive company. And they did it generating free cash flow. Holy smokes. We got a really impressive situation here. So their fundamentals are looking tremendous. We have 8 analysts covering the stock. And the worst case scenario is that an investor would lose basically 10% because the price target's $12. The stock is trading at $13.46. The stock is up in after hours trading. It's up 7%. And that's a pretty good bump. This is Saturday morning, so we're going to have a couple of days to wait because we don't have trading on Monday. So we'll see where that goes. Now, the most optimistic analyst believes the stock is way underpriced. It should be priced around its target price is $28, which is well above 100% return. And they're basing that on the current year performance. The earnings per share for 2025 is expected to be 77 cents. And the growth is going to be, according to analysts, is going to be pretty favorable, like 30, 40%. The company guided and said, hey, we're going to grow about 22%. But management teams tend to guide with a very conservative number that they feel they can beat. And that way, when they get to earnings, they're beating the earnings expectations and then raising. And then they build momentum in their stock. So that's what's going on there. Now, as we look at long-term growth, these guys are just going to keep growing. So that looks really, really good. And their profitability is going to expand. So again, as I look at this stock, I'm like, man, this is a really good company. It's a very good situation. Health insurance is not something that, hey, it's kind of cool today and nobody wants it tomorrow. No, it's something we need today, next year, in 10 years. Health insurance is important so we can continue to live long, healthy lives. When we need to go see the doctor, we can go see the doctor. If we need a surgery, boom. If we have an accident, we're taken care of. So the fundamentals look really impressive. So I believe that Oscar Health, using a very rational forecast on cash, is discounted by 90%. That's a heck of a discount. And you saw where the stock has been. It's been sold off. You see that other analysts are really bullish on this stock. And there's 2 super investors that are buying into Oscar. One of them is Michael Burry, who started a position in Oscar. And maybe that's where a lot of the chatter has been going on. But this stock, based on free cash flows, and I'm using a conservative free cash flow forecast. I'm actually forecasting as the beginning point 25% lower than their current year free cash flow, and then I'm trimming it by 15% for the first 4 years, bringing it down to $438 million. So I'm expecting, hey, their cash flow is going to be a little bumpy. It's going to be a little conservative. If it's better than that, then great. But I'm just trying to be conservative. Even when I'm very conservative, those cash flows are worth 121% more than their current market cap. They hold a lot of cash and investments. And I didn't even include long-term investments they have, upwards of $1 billion on this line. These guys are just cranking out cash and loading their balance sheet. They have very little debt. So a very solid company that has little risk of going bankrupt. Nonetheless, it's a small cap stock. So I'm saying, hey, I want a higher rate of return. 11% is the discount rate I'm using on all these numbers. And even when I use those conservative factors, I get a 121% discount based on free cash. When I use their earnings per share, give them an 18. This is a high growth company. You could easily say 36 here, but let's go 18. using a rational growth rate. They're supposed to grow higher than that. Their earnings per share is supposed to grow faster than that. I get a discount of 29%. So when I blend the two, I get to 90% discount. That's a very attractive proposition, and I'm going to buy shares of Oscar Health. Now, when's this stock going to rally? Of course, I don't know, and nobody knows. I do know that if I look in the rear view mirror, for the last 2 years, health insurance has not been a really desirable industry for the stock market. And at some point, that's going to turn. I think the fundamentals, I'm showing you a company that's cranking out cash, growing that top line, just executing on every metric. The market's going to turn. Looks like, a super investor like Michael Burry, he's a pretty smart dude, and he's invested in the company. So that is interesting. So at some point, I believe that the market's going to turn and start liking health insurance companies. And Oscar Health is looking really good. It's a small cap. It could double in value very quickly. This should be a really nice play for me. I currently own Elevance Health, which is in the same industry, much larger. It's harder for Elevance to grow fast, like 50%. Oscar could do that because they're small and they can grow very quickly. Also, their market cap, the stock could really fly up because it's only a $3 and some odd billion market cap, where Elevance is much, much larger. So Oscar Health is going to be a stock that I will be buying this coming week. I'm a dollar cost average investor, so I'll start a position and then buy over time. Especially, I'll accelerate the buying if I see the health insurance is beginning to rally. Because I do think that this year, health insurance will probably do well. We have technology stocks that are really expensive, and in some situations, things are getting out of hand. We have some financials that are getting out of hand. I own Robinhood. It's wonderful to see the stock just fly up, but the prices are getting pretty ridiculous and pretty irrational in some cases. And I think investors are beginning to rotate into sectors that really have been discounted for some time. And healthcare, I think, is one of those sectors that is receiving new inflows of capital. So we'll see. I think 2025 may be the year for healthcare. So that's my video on Oscar Health. Big thanks to the online community for giving me this idea. And I'm going to run with it and see if I can make some money. And hopefully you found this video interesting. And I'd love to hear your comments on Oscar Health, what you think of the company. And I really appreciate you watching. Good luck with your investments.